We've already seen what happens as mortgage rates dip, with purchase applications picking up, pending home sales picking up. Essentially, mortgage rates are driving the housing market and are likely to reshape 2025.
Jeb, why do mortgage rates matter? Is it just a number? It's obviously not a number because people are really fixated on it, fixated on their home price and their mortgage interest rate. And we're going to go through both of those things here today so you can see which is more important in terms of affordability. Because really, why do we care? Why do any of us care? We care about affordability. And people throw that around in different ways. Well, homes are unaffordable. Okay, well, that may be true. It may be true that it's unaffordable for you, for your friends, for your family in your area. Homes in this market, homes in that neighborhood are unaffordable. But when we talk about affordability, we're using a very specific sense of the term. When you see measures of affordability drop to an all-time low of 32%, 27%, in my area, 17%, what does that mean? Does it mean can the typical family afford the typical home at the current prevailing interest rates? So when we define those, what's a typical family? A family with a median household income. So we can look at the U.S. median. More importantly, probably need to look at the median for your area. You know, if you have the Iowa median income and you're trying to buy a house in Southern California, not super helpful. So the median income for your area, the median priced home for your area, and the one that's very volatile of the three components there is the prevailing current interest rate. So when we look at that, changes week to week, Jeb. Nothing else there is changing significantly from day to day, week to week. Mortgage rates absolutely do.
Well, one thing that I don't know that people understand clearly is that mortgage rates have a bigger impact on your monthly payment, more so than any of the other factors, right? Home prices can adjust up or down $5, $10, $15, $20,000, and it affects your payment depending on where the rate is, $5. It's like, okay, well, that didn't really do much. You can put a little bit more money down when buying a house, another 3 or 4%. And it's like, oh, it changed my payment $50. Okay, who cares? A move in interest rate, 0.5% move in an interest rate can affect your payment hundreds of dollars, depending on how much you're financing. So it really does have a bigger impact. And the idea at the moment, Josh, is that the average interest rate in 2025 is likely to be lower than what we've seen over the last couple of years, which in turn is going to lead to more transactions happening. So more homes coming to the market for one, more sales actually happening. So more homes closing escrow. And with that, we're going to have a different housing market than we've had over the last couple of years. So I think, Josh, let's talk about where rates have been over the last, let's even go back to Trump, right? Trump's coming back into office starting January. And, everybody wants to think that rates are going back there. So let's talk about where rates were, where they've been recently, and what we're likely to see.
The comment section is always a fun place to dwell, Jeb.
Well, let's do that. Josh, I think that's a good point. Where do you believe interest rates are going to be with Trump in office? Let us know in the comments right now. I think this is a really good point to put him in there before we start discussing them.
And I can already assure you, Jeb, the only people that are going to answer are the people that love Trump and think that rates will be at 0.5% by, say, mid-February, or people that hate Trump and he's awful and the economy is going to implode and we're all going to have nowhere to live. So those will be the only people.
Some middle.
So if you're a sane person in the middle of the bell curve and have an opinion there on how it's actually going to impact rates, please definitely share your opinion. Because what I was going to say is really the comments that we get are either Trump is going to fix everything and make rates go back to nothing, or Trump is going to ruin everything and our economy is going to implode and we need to get a bunker in the middle of Iowa. So from that perspective, let's do exactly what you said and just look back historically. So for 2024, we're not completely through the year, but the average year-to-date interest rate with the weekly readings from the Freddie Mac Primary Mortgage Market Survey, which is imperfect, but over the course of a year, it works out just fine. 6.72 for the year. Jeb, you predicted that ahead of time before I ran the number, almost on the dot. Jeb said 6.70. I was very impressed by his Nostradamus-like skills.
But if we go back to where I predicted rates to be in January, I'm way
okay.
off.
Okay, good.
So we're clear.
Good point. So 2023 strangely, although we feel like it felt very different the last 2 years, almost the same, 6.81%. So going back in time, we know that 2021, 2022, 2020 were sort of like the golden era of ultra low interest rates. So 2022, when we were coming out of that, 5.34 average for the year. So started out very low at about 3% and ended the year very high. So average for the year, 5.34. The two ultra low years, 2020 was 3.11, 2021 was 2.96.
You're going out of order, bro.
I did. I'm just there. I lumped them together. We had a 2-year period where rates were essentially 3%, and that was all COVID related. No matter who was in office, Trump, Biden, we had two of them. The government was forcing interest rates much, much lower, regardless of who your president was. So 2019, 3.94. 2018, 4.54. 2017, the first year of Trump's first presidency, 3.99. So basically 4%. Throughout Trump's presidency. And that was with, we've run through the numbers, inflation figures just over 2%. So we're higher than that. Most think we are normalizing. We've got some interesting figures on CPI this week. We get PCE next week. The Fed is still cutting. The Fed obviously thinks we are moderating, although we are not to their objective of where we want it to be. So at this point, after 2 years of almost 7% interest rates on average throughout the year, I think all of us, if you said, hey, we could get a 3.99 to 4.54 rate over the next 2-3 years, that would be pretty happy. No one is saying, hey, no, I'm not going to be happy unless I get all the way back to a 3% rate.
Yeah, and before we talk about predictions now for say 2025, let's take a second here, kind of go off topic and talk about some of the things impacting rates at the moment, because we got inflation numbers this week. They came in, essentially where the market was predicting, which was a positive thing. We saw, some positive reaction in bonds. And then Thursday, jobless claims. Jobless claims came in at the highest level that we've seen in probably 2 months. I don't know what the actual, stat was on that, 2 months, 3 months, whatever the number is, but way higher than expected. The market reacted positively with bonds. With the 10-year moving lower. But at the same time, we had some stuff happening overseas, Europe. We have right now a lot of different countries doing their own monetary policy, and predicting different things going forward. And that actually had a larger impact on our market here than what's happening in the U.S. economy. Josh, is that something that we have to pay attention to now? Because you and I have been talking inflation, employment. Those are the things driving it. Potential war, also something. But we haven't really been talking about other governments and what they're doing and how that's having an impact on rate. What do we need? I mean, is that something now?
Over time, when we talk about interest rates, we talk about stocks and bonds competing. So when stocks are doing really well, money comes out of bonds, goes into stocks, and vice versa. People are afraid of stocks, money goes into bonds, this flight to safety, and rates improve. Well, you have that allocation around the world also. If you're uncomfortable with money being in Europe, maybe you pull it back to the US. If you're uncomfortable with money in China because you're not sure of what's going on. So I don't think there's anything. The rest of the world's economies are much softer than the US. So whether that be China, whether it be Germany, whether it be the rest of Europe, I think what we're going to be looking at is that will be supportive of the U.S. being a haven for funds coming in. So the global trend is for lower interest rates as these economies stall out and are looking to stimulate by lowering interest rates. So we're a very interconnected global economy. I don't think we're going to be on an island with vastly elevated rates if the rest of the globe is cutting, which is what we saw yesterday.
Good stuff. Now let's talk about 2025, reshaping the housing market predictions, right? So this year we said we're going to end, assuming things stay about where they are right now, about 6.72 on the 30-year fixed average for the entire year. 2025 predictions from Logan out of Housing Wire, somebody that's a friend here to the show, been on a couple of times, is giving a range, and he uses a model for his range. It's not something he makes up like I do. I just make up what I think rates are going to be.
That's what I feel. I'm in my feelings.
That's what I feel. And clearly it has not worked. But no, in all reality, a model he uses, and it's giving a range of 5.75 to 7.25. So if we just took the middle of that, somewhere around 6.5%. The belief, Josh, is that as that rate, I guess, quote unquote, we're going to say normalizes to 6.5% or somewhere within that range, to the lower end of that range, that's going to give the housing market a little bit more steam and do some of the things that we talked about. What are your thoughts on that?
It will absolutely impact the market because we're going to see. We have some examples here. I want to run through some numbers for you that if we're at the higher end at 7.25, that's higher than where we've been the last 2 years, which has been a very slow market. So it goes without saying that we would have a slow market. The market would slow further, as hard as that seems to be possible to believe. Going, so we're at the lowest sales volume since the 90s, but it would slow even further. Now, if we're lower at 5.75, 1% lower than we've been over the last 2 years, it would absolutely stimulate the housing market. The question is to what degree, because people need homes to be able to buy. So how many people with ultra low interest rates are going to give those up? Well, as time passes, Jeb, we've seen that lock-in effect has decreased. People, when we're uncertain, when you're in the first year of rates being 3% or 3% above where you're at, you got a 3% rates or 6%, and go, I'm not doing this. I'll wait this out. Well, 2-3 years down the line, you went from 2 kids to 4 kids and they're bouncing off the walls. You start going, well, maybe I could give up my 3%. And we are seeing that from people having to give up that interest rate to get what they need. So less lock-in effect, more higher interest rate loans out there, less of the ultra low interest rate loans. So if we hit the low end of that range, we get under 6%, there will be a pickup in volume. And we've seen that. What did we see in August and September when we hit sort of the lows of the year? We saw sales pace increasing. We saw refinances increasing, which that in and of itself is a stimulus to the economy. When people are able to lower their payment, I believe I saw a number, the average drop in payment was about $400 for the average person that refinanced in that 60-day window where we had to lower. So all of that would be a positive for the economy, positive for households, positive for sales volume, positive for real estate and mortgage professionals.
Well, there's actually two things happening right now, Josh. You got people that haven't bought, that have been sitting on the sidelines waiting for something, the perfect house, rates to improve, prices to normalize, something, right? There's something out there. Maybe it just wasn't the right time in their life. You have all of those people. And then you have the people that own a house, and people who sell property typically buy another, right? Most sellers are buyers. And so what you have is exactly what you just said, Josh. And I know that because I'm starting to have conversations now with people who told me a year or two ago, I'll never sell this house. I'll never sell it. In fact, a buddy of mine lives here locally, big house in a neighborhood that he's just not a lot of kids. And he's told me, like, I think he's got he's got a big house and it's under 3%. And he's like, why would I ever sell this? And I'm like, you should never sell it. Recently he reached out and goes, hey, what do you think my house is worth? Why? Considering selling it. What? Yeah, it's just not the neighborhood we want to be in. So people are going through some of those things that, okay, yeah, at one point in my life, I would have never done that. Things have changed now. My kids want to be around other kids. We want to be around other adults. People our age. All of these different factors playing into it. We don't need this much space. All of these things, or I need more space. And that's causing people to change their minds, and which is going to increase inventory, right? The lock-in effect is going to loosen. Some people will never sell. Some people will. But how is all of this going to impact the market, Josh, just in terms of overall feel of the market? I think is important because a feeling of the market has an effect on the market. If people think I'm getting left behind, more quick to do something. If people think the market's stalling, it's not doing anything, well, I've got time. I don't need to do anything. So I think those two things are important in the psyche of the home buyer.
They're very important. But when we're talking, our audience here is primarily first-time home buyers. We have plenty of people that are move-up buyers that still, hey, I haven't done this in 7 or 8 years. I want to get back in the game and educate myself. But 80% of the audience is first-time buyers. So the answer is, what can I afford? Oftentimes I get the question, well, Josh, what can I afford? I have no idea. I can tell you what you can qualify for. You are the only one that can tell me what you can afford. So we ran some numbers here. Per Adam Research, as of September, the median U.S. home price is $4,045. For California, it's $776. So I'm going to give two different breakdowns in numbers. So let's use Logan's range at 5.75 with a 5% down, because I think that's pretty common. We have some people do 10, 20% down. We have a number of people do 3.5% down. 5's a good number for a first-time buyer to try and get a feel at that. So it would be at 5.75, that U.S. median of 4,045 is $2,242 a month. principal and interest, not all in. Taxes and insurance vary around the country. Mortgage insurance is going to vary, but at 7.25, it's $379 higher, 26.21. So it's 15% higher principal and interest payment. It would be naive to think that that's not impacting people. Someone going, hey, this is a car payment lower at 5.75 than it was at 7.25. So that's a pretty wide range. If we hit the middle of that, the difference between that 6.5 and 5.75 is probably about half of that, still $180. And that's for median priced homes.
That's real money.
Real money. My personal average loan amount this year, Jeb, you saw I ran through the numbers yesterday, $540,000. That includes refis, purchases, big down, big purchases, little purchases, but $540,000. The numbers are even bigger than that. So California, $776. This includes the Central Valley, way in Northern California that has very low prices, sort of like the Midwest. But $776 at 5.75, you're at a $4,300 principal and interest payment. At 7.25, it's $5,029, $725 more a month. That's real money. People are going to make their decisions based off of that. So does that payment look anything like it did when rates were 3%? No, because now we're probably talking another $1,000 lower. But most people have wrapped their mind around the fact that I missed that window. That window wasn't there for me, whether I wasn't the right age, whether I bought a house and it wasn't the right house, whether I got a job transfer. So there are a lot of people that are rightfully concluding, hey, I can't make this decision. I can't bite this off right now. But they would at those lower payments. So from that perspective, I think it's important. You hit on something very important a minute ago, Jeb. In terms of being able to afford, what lever not only is interest the most volatile, where it can move the most in the shortest time frame versus home prices and wages, it also has the biggest impact. There's a reason why home builders are buying your rate down 0.5 to 1%, because it makes the home massively more affordable, much more so than cutting the price on their home would. So from that perspective, I wanted to look at what's the difference? How much money does your household need to make? So at 5.75, buying that $404,000 house with a 35% debt to income ratio, these are pretty rough numbers. You need household income of $8,000. So closing in on $100,000 to buy a $405,000 house. But if we go up to 7.25, now we need $9,350. It's like $15,000 more a year. That's a significant difference. So when you can say, not only are there that many people more willing to bite off the payment at 5.75, there are more that are able to. Like the mortgage guidelines wouldn't even get you in the door, but you're able to. So now the higher we go up on this, 776, you need 15,000 household income at 5.75. It goes up to 18,000 a month household income at 7.25. It's $35,000 difference. That's a full-time jobs difference there between those. So even if that is the range from high to low on that, you're seeing a big difference. Does it mean a stampede of home buyers at 5.75? Probably not, but it's probably a trickle at 7.25 if we look at it that way. So comparing that, what do we look at? We want to talk about wages. We've gone through this. We went through this in the live show this week. Wage growth has been above trend for the last 3-4 years post-COVID. 4, 5, 6% a year. And many professionals, many people who are making that $8,000 a month household income, $15,000 a month household income, they're good, valuable employees. They're getting these 4, 5, 6% increases. If you got a 5% raise and you were in that $8,000 a month household income, so the household gets a 5% raise, that's $400 a month. Go back, that's the difference between 7.25 and 5.75. So in a perfect world, you kind of get both. The household gets a 4 or 5% raise, income goes up $400 a month, payment comes down $200, $300, $400 a month. It's a big change to affordability. So before someone goes bonkers in the comment section and says that still doesn't make homes affordable, it does for a lot of people. It doesn't for everyone. It does for a lot of people. And it doesn't mean that we're happy, we're stoked with what that payment is, but most households, 65% of U.S. households over any time frame in the last 50, 60 years choose to become homeowners. And that reality with $400 more monthly income and a $400 lower payment is going to open doors. There will be more sales. There will be more buyers. And when we look at the numbers, if you have that $15,000 household income, it's $750 a month extra. So again, what did we say? The difference is $725 on it. You're talking now $1,500 of additional household income there on the increase in income and the decrease in the monthly payment if we see that. So obviously everyone's situation is unique. Everyone's mileage is going to vary there. And the last one, Jeb, to close the loop, this is where people are going to be really, really disappointed, especially those sitting around going, home prices are going to crash. I'm going to buy when they're nothing. If we saw a 5% drop in prices, so for that 404.5 house goes to 384, 275. So from 405 to 385, if rates are 575, it drops your payment $111 a month. At 7.25, it drops at $130 a month. So that California median 776 drops at $215 to $250 a month, depending where interest rates are. So it's just a much weaker lever in terms of increasing affordability for people. We're going to go through our forecast. We're going to go through an episode in the coming weeks of the major forecasts, but we showed one on the live show this week. Jeb, the consensus is somewhere for around 3% appreciation. So the good news is 3% appreciation maybe adds $80 to $200 to a monthly payment if you got in at the far end of the year and paid next year's high prices. But if you're sitting here saying, I'm waiting for prices to drop so homes become affordable, you are much better off focusing on what can I do to get a better job at a higher pay rate, a raise, a new position, and hoping that the economy cooperates and interest rates drop.
Now, before we talk about what you should do right now, do us a favor if you're finding any value in the show at all and hit that thumbs up. And if you're not following us and staying up to date on everything first-time homebuyer related, do us a favor and subscribe to the channel. So Josh, people that are listening at the moment are probably home buyers. They want to become home buyers. They're move-up buyers or somewhere in the game at the moment, and they're looking for answers. What can I do now? What should I do now? How do I set myself up in the best position? You asked me that question prior to coming on, and the answer is pretty simple. Start the process now. Maybe you're not ready now. Maybe you're not going to be ready until June or July or August of next year. January, December, whenever it is, start the conversation, gather the paperwork, start talking to your lender. If our team can be of assistance in the process, we would love the opportunity. You can reach us using the link in the description of this video, but it's about reaching out, talking about where you want to be, what you're trying to accomplish, letting Josh, the team here, look at your pay stubs, your tax returns, your credit report, analyzing it, and telling you where you stand now and where you might be if rates go down. And does that impact what you're able to do? Should you wait? Should you buy? All of those things are options, right? But the sooner you know, the more you can do to prepare yourself. If you need to work on your credit, you can do it. If you need to save a little bit more money for your down payment, you can do it. If you need to file a little bit different tax returns so you can qualify for more home because you haven't filed 2024 yet, you can do it. The sooner you do that, the better. What often happens is people reaching out, trying to have the conversation after the fact. They've already done the things that they shouldn't have done because they didn't know what they shouldn't do. Does that make any sense? But anyhow, that's where you should be. So focus on that, Josh. Anything to add?
It's self-serving when you're a lender to say start with a lender, but what you said is really important. I had 3 conversations this week that are sort of instructive along these lines. 2 were people that are preppers. They like to be prepared. They're not doing anything until Q2 next year.
Are they doom preppers?
They're not doomsday preppers. They're positivity preppers. They are getting ready to get the outcome that they want. So they're 3-6 months out, but they wanted to go through and say, are my ducks in a row? Anything here that I should be working on? And we had another one who, again, they didn't go out and start looking at houses. They want to start looking in January. And we go through that and say, well, there's an issue here. And it's a child support issue that's going to be improving, but it doesn't improve until after the holidays. And so now we know here's what we have to get done. So those situations are just basic prep, but kind of what we just went through. What would I do if someone called up today, said, I want to buy next year, don't know what this looks like, where I'm at? We're going to do a pre-approval. If you don't want to go through that process of providing documentation, maybe we just do the pre-qual. You tell me, hey, your hourly rate, your annual salary. We go through and list out your debts and get a back of the napkin number that gives you a pretty solid idea. But what that does is it tells us, are we likely to do an FHA loan? Are we looking at a 10% down, 20% down conventional? And then we can run those numbers and model it out. What does it look like if rates drop to 5.75? What does it look like at 6.5? What does it look like at 7.25? So as you're watching the news, those aren't just random numbers popping up on the screen. You go, oh, hey, at 6.8, I didn't like it. I just saw the national average is at 6.25. I got to call Josh. I got to call my loan officer because it looks like that was sort of our trigger of where we wanted to jump in. Now, Jeb, one of my least favorite sayings of all time, but that got popularized as rates jumped up the last couple of years is marry the house and date the rate. The LA Times ran an article about 4 or 5 months ago when rates were kind of at their high for the year. All of these people who had either done buy downs to get a temporary lower payment or who had just bit off more payment than they were comfortable with. And they're sitting here going, we are panicked because our plan was rates were going to go to 5%. We were going to refinance and everything would be good. You have to plan for the worst, hope for the best, but plan for the worst. If your plan involves you needing to refinance, that's not a good plan. If your plan involves, hey, I'm cool here, but it sure would be nice if I could refinance, that would be helpful. We have a listener to the show who we've actually done 3 loans for since October of 2023. They wanted to buy, they did their homework. He was one of those guys that reached out about 4, 5, 6 months ahead of time, got all their ducks in a row. He was waiting, hoping that rates were going to be coming down through 2023, and they didn't. They ended up buying at 7.375. He took our advice. He did it at 0 points instead of trying to buy that rate down to 6.99, 6.875, whatever it could have been. And sure enough, last spring, we got the opportunity. We got him down to 6.625, 6.75 with a no-cost refinance. And we were able to go from a 30-year loan to a 29-year loan because he was comfortable with that payment. So we actually cut 6 years off of the 6 months off of his loan while lowering his interest rate and lowering his payment. Well, sure enough, we get to the end of the year, September, brand it down to 5.89. So he's dropped 1.5% on a loan that looks real similar to that 776 California median that we looked at. So payment much lower. We've shaved time off by going with a custom loan term. Haven't charged him anything because he understands, hey, we may have an opportunity to do this again going forward. So I don't want to pay closing costs or buy an interest rate down. And he's just going to keep doing this. And if someday we get an opportunity to put him down to 5.25 or 4.75, he's in that same position to do that. And I say it's he and his wife, dual income household, very common here in higher cost areas like Southern California. But from that situation, I want you to go into it with that sort of mindset. I will do this if I'm comfortable being in this loan for the next 30 years. I'm not going to do this doing some type of buy down to make myself comfortable for the next 12, 24, 36 months and then be in a panic if the market doesn't cooperate. You and I both agree or both believe or in agreement in the belief that rates are going to move lower. Where that ultimate bottom is, no one knows. How quickly we move there, no one knows. But I believe the economy will slow. I believe inflation will recede. I believe rates will be better. But I don't want anyone making decisions based off of that belief. It's not a fact. I don't have, 100% conviction. I can't tell you that. So again, had a borrower yesterday, Jeb, just asking me, well, what are rates going to be in January? I think we should just wait till January. I said, I have no idea what rates are going to be in January. If we did, my job would be a lot easier and maybe there would be a lot more competition if everyone just knew for certain what happens. We are making decisions, we as mortgage professionals, realtors, and you most importantly as a home buyer or homeowner are making decisions with incomplete, imperfect information. Find people you trust who are educated and can educate you and then make the best decision knowing that we don't have any guarantees of what's going to happen going forward.
And if our team and I could be of any assistance to you, use the referral link in the description of the video. Until next time, buy right, borrow smart, build wealth. Adios.
Amigos.